Right, welcome to today's webinar, the latest in the spring season. Just to state now, if at various points we will be having some questions. If you've got any questions to ask, I would suggest you type them into the Q&A box as you're thinking of them, and then we'll pick them up at the end of each section. That works out the easiest way of dealing with them all. So next slide, please. Right, today we've got Sadiq's missing. Speakers for the hot topics are Marvin and Sadiq, who are regular speakers, so you know them both. On the later topics, Rebecca is dealing with the section on basically how to pay your IHT bills, with a little input from myself. And Kian is then doing the second section on basically Irish tax and moving to Ireland and such like. Next slide, please. And there's the agenda. I say number 3, ignore that. That's actually part of the other one. So right, top news. Sadiq, are you on?
Yes, thanks, Chris.
Yeah.
And
Okay.
good afternoon, everyone. So if you go on to the next slide, it should show a table. So I'm just going to remind everyone of the rules that are going to be incoming in April, because it's the end of the tax year. So here's some deadlines which might interest you. So on the 26th of March, Rachel Reeves is going to make her spring forecast statement to the Parliament. And there might be some interesting tax announcements in her speech, some minor ones which maybe change some of the recent tax announcements. So that's one to watch out for. From 1st April, the national minimum wage increases take effect. These are the increases which were announced at the autumn budget. So just to remind you all, for over 21s, the rate will increase from £11.44 to £12.21. So that's an increase of around 7%. But the big increase is to the 18 to 20-year-olds, which is the bigger ever increase from £8.60 to £10. So that's an increase of 16%. On 4th of April, there'll be gender pay reporting regulations so these are for employers with more than 250 employees. They must publicly report their gender pay information. So if there is any gap between the male and female pay, they must report that if they have more than 250 employees. And they have to do that every year on the 4th of April, by the 4th of April. Different dates apply for public sector employees. And so for those employers, they must report by 30th of March every single year. 5th April is the tax year deadline for individuals. So this is the deadline for applying for payrolling of benefits. This is a new thing, payrolling benefits for the 25-26 tax year. And then it's going to become mandatory from April 2026 to payroll benefits for employers. It's also the last year you can make contributions to pensions, ISAs, and other tax-saved investments for the 24-25 tax year before the new one starts on 6th April. Just a reminder that on 6th April, the increases to employers' NICs takes effect. So that means that the Class 1 NIC threshold will decrease from 9,100 to 5,000, and employers' NIC increases by 1.2% to 15%. Beneficially, the employment NIC allowance is still going to increase from 5,000 to 10,500. So they were the big NIC increases that were announced in the budget, autumn budget. 14th April is the filing deadline for CT61 returns for the quarter to 31st March. So just a reminder, CT61 returns is where you might have companies which pay interest and royalties abroad, and they must usually withhold 20% basic rate income tax before they make those payments. So that's the filing deadline, the CT61 returns. 14 April is also the QIP deadline for large companies with the 31st December year end. And finally, 30th of April is the 8ed return deadline. So this is where a company usually owns a residential dwelling which is worth more than 500 grand. It has to make 8ed return deadlines and pays the charge. Interestingly, if the company qualifies for 8ed relief, it also has to make an 8ed relief claim, and the deadline is also 3rd of April. So that's the end of the direct tax news, which is this deadline. So if you go on to the next slide, Marvin, you can take over, talk about VAT.
Okay, well, thanks, Sadiq. I'm going to start by mentioning a new government consultation on electronic invoicing. This was promised in the autumn 2024 economic statement, and the government has now published a 12-week consultation that runs until the 10th of May regarding the potential rollout of increased business-to-business and business-to-government e-invoicing. The consultation is open for businesses of all sizes to respond, as well as software providers and professional advisors. The stated aim is to gather views on standardising e-invoicing and how to increase its adoption across UK business and the public sector, which is all part of the government's aim to cut paperwork and to help improve productivity. The purpose of the consultation is to ask for views on whether there should be a centralised or a decentralised approach, the standards that may be applicable, and what general approach could be taken to mandating e-invoicing, or whether it should be voluntary. For example, should it apply to businesses in certain sectors or of certain sizes? Consultation also explores different e-invoicing models and seeks views on requirements that may assist the tax authorities, including real-time digital reporting. It'll be interesting to see how the rules around e-invoicing develop. It will no doubt result in some technical challenges for some businesses and smaller public sector bodies, similar to those on the rollout of Making Tax Digital for VAT. Could ultimately lead to more automation of tax reporting, and a data feed could improve HMRC's ability to accurately target compliance activity, potentially reducing the need for checks on compliant businesses. Following this initial consultation, the government will consider the views, and further more focused consultations will be expected. Moving on to some proposed changes for e-commerce in the EU, which will affect businesses that import low-value goods into the EU, including UK businesses that sell to EU consumers. These changes have been proposed by the European Commission with a view to reducing alleged abuse of the low-value import rules. So what's prompted the proposals is an increase in the number of parcels being imported into the EU from countries such as China that are taking advantage of the €150 import duty threshold. There was already a proposed strategy for making customs duty changes, which would have had an expected start date of 2028 before being made compulsory in 2038. But the Commission is now urging more urgent action and has released what it calls an EU toolbox for safe and sustainable e-commerce, which aims to take action to tackle risks stemming from low-value imports sold via non-EU online retailers and marketplaces hosting non-EU traders. The Commission says that last year, around 4.6 billion low-value consignments, so goods with a value not exceeding €150, entered the EU market, which equates to about 12 million parcels a day, with 91% of these arriving from China. This is twice as many as in 2023 and 3 times as many as in 2022, and many of the goods have been found to be non-compliant with EU legislation. So what the Commission is doing, it's encouraging measures such as more stringent customs controls, and the report also calls for customs reform, including the removal of the duty exemption for low-value parcels, as well as further measures such as introducing handling fees on e-commerce items to address the increasing costs of supervising compliance of billions of such consignments. There are other proposals in respect of improved consumer protection regulations, such as those to protect consumers on online marketplaces and through raising awareness of consumer rights, risks, and redress mechanisms. So in summary, there are no immediate changes. It can take a very long time for the EU to make any changes because it requires all member states to agree to new legislation. But it's apparent how things are going to change over the coming years. And the Commission says that they will assess the effect of the announced actions and will publish a report within the next year on the increased controls that they are proposing. So if you've got any clients that import low-value goods into the EU, they should monitor this as it develops. For example, sales by UK businesses to EU consumers would face extra costs under these proposed rules, with increased customs duty and possibly handling fees. So it may have a big impact on profitability unless prices rise. And there'll also be extra complexity, which will potentially result in delays. There have been no proposed changes as yet as regards the UK's equivalent of the £135 low-value threshold for imports into the UK, but this is something that also could change over time if the EU makes some changes. So So now I'm going to talk about a decision of the first tier tribunal in a case called Advanced Hair Technology Limited. And this relates to the medical exemption and further highlights the difficulty in falling within the exemption. So the taxpayer operates a clinic on Harley Street and provides solutions, typically hair transplants, to deal with a type of alopecia that results in hair loss in both men and women and primarily affects the top and front of the scalp. The taxpayer was treating its sales as exempt from VAT, but in 2018, HMRC retrospectively registered the clinic from 2007 and issued a decision that the majority of the company's supplies of hair transplant services were standard rated and raised an assessment for over £2 million of undeclared output tax. The company argued that its services fell within the medical exemption, which applies to services with the purpose of diagnosing, treating, or curing diseases or health disorders, or to protect, maintain, or restore human health. The question for the tribunal was whether the company's activities did comprise these elements. So this included consideration of issues such as whether the hair transplantation has a therapeutic purpose of treating psychological or psychiatric problems, whether the particular form of alopecia is a disease, and whether the company's treatments protected, maintained, or restored the health of its patients. On the other hand, if the services are purely cosmetic, this wouldn't fall within the exemption. So a key aspect arising from previous case law is that health services provided by registered health professionals will only qualify for the VAT exemption where their principal purpose is to protect, maintain, or restore the health of the individual concerned. The tribunal decided on the basis of the evidence provided that this particular form of alopecia was a disease. However, the company failed to provide sufficient evidence regarding the mental health benefits of the service it provides. The tribunal considered the treatments were purely cosmetic and were different to, say, breast reconstruction following a mastectomy or plastic surgery in the case of burns, because although the hair transplantation solutions treated the condition, it was not to cure or to restore normal appearance, given that hair loss is very common and is part of the aging process. Therefore, it refused the appeal. The tribunal added that exemption would apply for treating hair loss due to cancer treatment, for example, as that treatment would then form part of the cancer treatment, but this is not the case in this the particular scenario. This is another in a long line of cases where HMRC actively challenge situations where the medical exemption is being applied and have been winning a lot of these cases. And the key point to take away is that just because a registered medical professional is involved, it doesn't necessarily mean that the activity falls within the medical exemption. And where the treatment is purely cosmetic, rather than to protect, maintain, or restore health of an individual, such cosmetic treatments are standard rated. If you have any clients that apply the medical exemption in this type of scenario, it's worth checking that this is still correct in light of these cases. And finally, I'm just going to mention that HMRC has released 3 evaluation reports in respect of the introduction of Making Tax Digital for VAT, which has been based on interviews with various people impacted. You've no doubt have some clients that have faced challenges in meeting the requirements of the new regulations. HMRC is reporting generally positive benefits from the introduction of MTD in terms of revenue gains, savings in times, although a lot of users have suffered extra costs as a result. The stats don't present a wholly positive impact, but clearly the government sees extra digitisation as a key policy and will use the findings from these reports to work to the planned extension of Making Tax Digital to other taxes over the coming years. Okay, next slide, please.
Thanks, Marv. Right, there's only one quick question come up about the slides. Just to say yes, we will send the slides out along with a copy of the recording. So that's that. No other questions. So next slide, please. Right now, so I'd say Rebecca. I don't know why my name's on there, but Rebecca's mostly going to talk about the IHT changes or more particularly how mechanism for helping you pay those IHT liabilities that now fall through. So over to Rebecca.
Thank you very much. Can I have the next slide, please? Thank you. So just as a very quick recap of the business property relief, use them interchangeably, rules as they stand. So the relief originally was designed to allow businesses to pass free of inheritance tax, which makes sense given that the assets that we're talking about are generally quite illiquid and can be quite difficult to fund any inheritance tax liability. So that's why the business property relief rules were brought in. To qualify for business property relief, property needs to meet a few conditions. So it needs to be relevant business property, needs to be owned by the transferor for 2 years prior to the transfer, and the business in question must not be wholly or mainly an investment company. I won't go into those rules in detail because it's not really the point of today, but let me know if you've got any further questions on that. There also must not be a binding contract for sale, and relief is given it at 100% for shares in a qualifying company, interests in a business, so a sole trade business or a partnership. Relief is given at 50% for some assets, such as assets owned by an individual used in their company that carries out a qualifying activity. Next slide, please. So again, as a very quick recap of the changes that we saw announced in the 2024 autumn budget. From 6th of April 2026, where we have assets that qualify for business relief and agricultural relief, the first £1 million will continue to receive relief at 100%. Any value in excess of that 1 million will only receive relief at 50% going forwards. So if someone dies with assets qualifying for business relief but in excess of 1 million, the value in excess of that 1 million will receive an effective inheritance tax rate of 20%. And it's important to note that that £1 million limit will cover both business relief and agricultural property relief assets, so you don't get £1 million each. The £1 million limit is not transferable, so will, if not used on death, will disappear, can't be transferred to the spouse. And another change that we saw announced was in relation to AIM listed shares. So I personally expected AIM to go completely and not qualify for business relief at all in future. So this was probably quite a nice result. And those shares will qualify for 50% business relief from 6th of April 2026. There's no change in assets that currently get the 50% relief anyway, and they're not subject to that £1 million limit. And then the same rules will apply to assets held within trusts. So the trusts will again get a £1 million limit when we're thinking about exit charges and tenure charges. And then anything over and above that 1 million will get relief at 50% again. Important to note that we don't have any draft legislation yet. So we're basing a lot of what our discussions with clients around what we think we will see. But we did have the consultation issued a couple of weeks ago, late February. So it gives us a little bit more information on what we think we'll see in the legislation and confirms a few points that maybe weren't clear before. So that's helpful. And BDO will be preparing a response to that consultation as well. Next slide, please. Thank you. So, of course, we had some anti-forestalling measures introduced at the same time as these new changes were announced. The first one of them was in relation to transfers that are made on or after the 30th of October 2024, but the donor dies after 6th of April 2026, then the new rules will apply and that £1 million limit will be relevant, and anything in excess of that £1 million will be subject to 50% relief rather than the 100% relief that we thought would apply during lifetime. If you had clients that made transfers before the 30th of October 2024, so up to midnight on the 29th of October, even if they pass away within 7 years and after the 6th of April 2026, the old current rules will apply to those transfers. So they should be fine, provided the transfer qualified for business relief at the time and the transferor continues to hold the asset and it remains unquoted company, all of that. Where we have transfers made on or after 30th of October 2024, but the donor dies before the new rules come in on 6th of April 2026, then again, they're not going to be affected. So they will continue to qualify for the rules as they stand now. The second lot of anti-forestalling measures that we saw announced were in relation to the use of multiple trusts. So where a settler creates multiple trusts on or after the 30th of October 2024, then that £1 million limit will be shared between the trusts on a first in sort of basis. So the earlier trusts will get the limit first. And it will be spread between each related settlement. The consultation document as well also talks about anti-fragmentation. So even ignoring the effect of the shared £1 million limit, individuals could still consider transferring assets into multiple trusts to try and take benefit of minority discounts, for example, for minority shareholdings. And there is a proposal in the consultation document to essentially ignore that and bring all assets within related trusts together when valuing them for IHT purposes. So it'll be interesting to see how that one will work. And then just to confirm, trusts created before the 30th of October 2024 will each get a £1 million allowance, even if they have the same settler. Next slide again, please. So what are some of the options that are available and things to talk to clients about? The first one is potentially considering gifts of shares into trust before the 6th of April 2026. So as you'll be aware, ordinarily a gift into trust can give rise to an inheritance tax charge, but that can be relieved if the asset qualifies for business relief. So whilst we still have the current business relief rules in place, individuals can consider gifting assets to trust and claiming relief in full. But there are a couple of things to think about there. So if the settler dies before April 2026, then as I said, when we're considering the gifts made in the 7 years prior to death, they should qualify for business relief in full. If they make the gift now before the 6th of April 2026, but they die within 7 years and after 6th of April 2026, then the new rules will apply when considering any IHT charge on the lifetime transfers. Insurance there, Chris is going to touch on later, so I won't talk about that. Again, things to consider with trusts is the 10-year anniversary charge. So provided the trust holds business relief qualifying assets, then the charges are reduced to an effective 3% every 10 years. So you're not getting away from the IHT liability, but it is something that's a little bit easier to plan for because trustees will know what the liability will be, or a rough estimate, and they know exactly when it's going to arise. So it makes it a little bit easier to plan for when compared with death, which you just don't know when is going to happen. Other things to think about. So I mentioned before about the £1 million allowance not being transferable. So it's key for clients to make sure that they're taking advantage of 2 lots of £1 million allowance if they're a married couple, making sure each spouse owns at least £1 million worth of assets that they can pass on death. They should also make sure that not all assets pass to their spouse, which is quite common when we're talking about mirror wills. So they might want to restructure their wills to ensure that they bank that £1 million allowance on the first death. And then other things to think about, again, direct gifts rather than gifts to trust. Same rules apply as currently, and then we just need to consider the business relief rules as and when the donor passes away. So whether that's before April 2026 or after will affect the availability of business relief. For both direct gifts and gifts into trust, we also need to consider capital gains tax potentially, but there is likely to be either 165 or 260 relief available there. Another option potentially is looking at the use of growth shares. So as you'll know, that doesn't get rid of the IHT liability. It doesn't necessarily reduce it, but what it does do is cap the IHT liability at a set value, a known number, and then the future growth in value can pass to children, to a trust, and we know what that figure is going to be then. So again, it makes it a little bit easier to plan for the inheritance tax arising in the future on death. Next slide, please. So I've talked about some of the options available, but you'll note that most of those rely on the donor surviving for 7 years or passing away before the 6th of April 2026, which can make it a little bit more difficult to plan with when we're talking about, say, elderly clients who might not necessarily survive the 7 years required. So there are just a few other things maybe to think about there. The first one is, as I mentioned, thinking of growth shares. So the creation and then the gift of growth shares, there's no, provided it's all done correctly and valued correctly and structured properly, there's not necessarily a gift or a transfer of value when the growth shares are gifted. So they can make those gifts and it might not be necessarily reducing their IHT liability, but as I say, we've capped it. And if they do pass away within 7 years, there's nothing to bring back into charge because there was no or little transfer of value. But as I say, not necessarily as effective as giving away ordinary shares because you're not reducing the value of the current estate. Again, the use of spousal exemption. So after making sure that the individual has used their first £1 million of allowance, could assets pass to the surviving spouse and benefit from the CGT uplift, benefit from the spousal exemption, and then the surviving spouse is the one that looks to make lifetime gifts. Again, with that one, you're relying on the fact that the surviving spouse then has to survive 7 years as well. So there's a lot of uncertainty and a lot of, I guess, taking a punt on some of these things. But again, not helpful if clients are married or don't have a spouse to transfer assets to. A final point to note is the importance of valuation. So our valuations team have been very busy lately with a lot of inquiries, people wanting to understand what the liability might be when the new rules come into play. So that I think is going to be key because previously we never really had to bother with valuations of assets that qualify for relief in full. It just didn't really matter too much, but I think they're going to be quite important going forwards. And obtaining a value then makes it a little bit easier to plan for in the future. Next slide, please. So then talking about options for funding the inheritance tax liability after the new rules come in and if the options are limited in terms of gifting and things like that. The first option really is to consider the purchase of own shares by the company. So when the individual dies owning the shares, the executors could consider asking the company to buy back the shares from the estate. The executors will have received a CGT base cost uplift. So provided the purchase of own shares falls within the capital treatment, and I'll talk about the conditions in a minute, then the amount received on the purchase of own shares the capital gain is going to be calculated on the difference between the amount received and that uplifted base cost. So it could be that the purchase of own shares can be carried out quite tax efficiently if there has been little increase in value since the date of death. Any increase in value would be taxed at 24%. And this is a lot better treatment than your normal purchase of own shares treatment, which could be taxed as a dividend, which we don't want to get into. So in order to get capital treatment on a purchase of own shares, then the following conditions have to be met. It has to be an unquoted trading company. The whole of the payment has to be used by the recipient to fund the IHT liability, and it must be used to pay the IHT liability within 2 years of death. And also, the IHT liability must not have been able to be satisfied without undue hardship. So the executors will have to demonstrate that the only way that they could have funded the IHT liability is by this purchase of own shares and couldn't have been funded from other assets within the estate, for example. I think that one will be quite interesting in terms of how people demonstrate that, because it's not really something we've ever had to consider or prove before. So it'll be interesting to see what Stance HMRC take on that one. Next slide, please. Another option for funding the IHT liability is thinking about payments in instalments. So currently you can elect to pay the IHT in instalments on certain assets, and you can get up to 10 years of instalment payments. There are currently some quite complex and quite hard to understand rules around where assets will qualify for interest-free instalments, but thankfully the consultation document around the APR and BPR changes provides quite a lot of clarity in terms of what will qualify for interest-free instalments, and it quite clearly states that all assets qualifying for APR or BPR will qualify for those interest-free instalments. So where someone passes away holding APR or BPR assets, the executors can opt to pay the inheritance tax in 10 annual interest-free instalments if they'd like to. The only point to consider is if the asset is sold, then the IHT liability on that asset just becomes payable. And another point to note is that you can actually also elect for the instalment options for chargeable lifetime transfers too. Next slide, please. I think over to Chris.
Thank you very much. The reason I've been asked to do this slide is not because I know anything about IHT, because I don't. But I'm part of the financial products tax advisory team within the firm, so I do a lot of insurance related work. So just to state the obvious, there's an interesting spin at the end of this, which is the reason I'm really talking. But just to emphasise, as has always been the case, if there's an anticipated IHT liability or possibility of an IHT liability, it is possible to take out life insurance thereon to pay the tax when it falls due. Ordinarily, you'd normally see that sort of covered by a single premium, but it is possible to pay it as a premium over a number of years. It's normally a single premium payment. Normally, the beneficiary is the estate, because it's normally the estate that has to pay the IHT, but it could be that if the donee has to pay the IHT. Well, the donee does pay the IHT on gifts that they receive during their lifetime, but unless the will specifically states that the estate's going to pick up any tax that falls on such gifts. So it could be that you want to underwrite the donee as the beneficiary of the policy, in which case technically that is another gift. So often people try and do it in such a way that it's a gift out of income, so falls within that exemption. So there's a few things around paying the premium such like which need to be thought about. From a practical position, we have discovered we've approached a couple of insurance companies recently following all the changes to IHT, and they simply said at this point in time they cannot insure against a possible change in IHT legislation. Because the IHT legislation or the BR and stuff has not been enacted, at the moment they won't even consider an insurance policy. They can't underwrite a risk that doesn't exist, because at this point in time there is no risk because there's no legislation. So I think if you're looking at this at the moment, and you've got some clients do some transactions at the moment which are in advance of this, They've just got to be conscious that as and when the legislation comes in, that's the point where they can take out insurance, which might mean it's going to cost slightly more further 2 years down the line, but there we are. That was all I was going to say on life insurance. So next slide, please. Right, we don't have any Q&As. I was just going to say Rebecca's comment on purchase your own shares. I'm also the corporate restructuring champion within BDO, and I put a shout out recently about, has anybody done purchase your own shares for inheritance tax purposes? We found one person in the whole of BDO had done it. So these things are rare, have been rare, but we're expecting them to become more popular coming on. So just to reiterate what Rebecca said, it's going to be an interesting thing going forward. Right, next slide, please. No more questions come in. So I'm going to pass over to Kian. Now, just as a background, Kian is a partner in our Irish firm, so is well placed to talk to us about moving to Ireland. Thanks, Kian.
Good afternoon, everyone. Thanks, Chris. Welcome to this webinar from a sunny but cool afternoon here in Dublin. As Chris said, I'm a partner in our private clients tax team here in Ireland, and I'm going to give you a bit of an overview around the remittance-based tax in Ireland, which hopefully you'll be familiar with from the UK regime, and also just general considerations around relocations to and from Ireland and post UK budget, where the remittance-based tax was abolished. This is an area where we've seen a large uptick in inquiries. So hopefully I can give you a bit of an overview of how our regime operates and some of the more nuances and pitfalls to watch out when considering it. So if we move on to the next slide, please. So this is just a screen grab from our global relocations report that we publish every number of years. It's a really handy report and a ladybird guide to the various different regimes that are operated for non-residents or non-DOMs around the world. And in bright red there you have the countries that operate the remittance-based tax. This predates the UK changes, so the UK shouldn't be in bright red there anymore. Probably should be in dark grey with the FIGS regime that's been introduced. But I guess the takeaway is the remittance-based tax, it's a unique enough base of tax. If your eyesight is really good and you squint, you can see Malta is also there at the foot of Italy, so they also have a remittance-based tax. Next slide. So the rates of tax in Ireland, you may or may not be familiar with this. I won't spend too long on it, but for income tax, our marginal rates are 52 or 55%. That's made up of a trifecta of income tax, a universal social charge, and our social security, which is PRSI. So our income tax rates are 20%, increasing to 40% on income over 44,000. So you enter into a higher bracket at a fairly low income level in Ireland. And then USC, you get into the top rate of 8% on over 70,000 euro worth of income. And then there's a 3% USC surcharge on top of that for any non-PAYE, so non-salaried income over 100,000. And then we have a flat rate of social security, which is actually 4.1% now in the last couple of weeks. Our CGT rate is 33%. Our capital acquisitions tax, so our version of IHT, is 33%. It applies on gifts and inheritances, so not just on inheritances, on all gifts, and there's no 7-year taper in Ireland. Standard rate of VAT is 23%. Stamp duty rates range from 1 to 10%. Residential properties 1 and 2%. And local property tax is 1 and 2%, and we've no wealth taxes in Ireland. So next slide, please. So your scope to Irish tax depends on 2 factors. It is your residence and domicile. I'll just touch on these very briefly. Next slide, please. So the Irish tax residency rules, these are black and white. They're clear and unambiguous, and they give certainty to taxpayers in Ireland, whether they are triggering tax residency or not. For residency, if you spend 183 days or more in Ireland in the year of assessment, which is a calendar year, 1 January to 31 December, then you're a resident for that year. Or the other test is the 280-day test. So the preceding year and current year, if you spend 280 days or more over those 2 years, with at least 30 days in both years, you will have tax residency in the second year. So in 2025, if you had spent, let's say, 150 days in Ireland in 2024, in the calendar year 2024, you wouldn't be tax resident in 2024 because you haven't done 183 days. But then in 2025, if you did 130 or more, then you're tax resident in 2025, as over the 2 years, you've done your 280 days. And if you're present in Ireland at any time during the day, then that counts as a day's residency for tax purposes. We also have a concept of ordinarily resident, and you trigger ordinarily tax residency if you have had 3 consecutive years of residence in Ireland. And you'll retain that until you've ceased to have 3 consecutive years of residence in Ireland. And I guess it is a tail or an added tag that applies to people coming and going from Ireland. The implications of being ordinarily resident are much the same as being resident, bar a few nuances around employment taxes, foreign employment taxes, and foreign trades and professions. Next slide. The domicile, we apply the same concept of domicile as you'd be familiar with from the UK. It is not defined in Irish tax legislation. It is a common law concept, and we've had a number of decisions before Irish courts which follow the UK precedent on this issue. In very basic terms, it is the country with which an individual views as their real home and has their closest ties with. Every person must have a domicile, and you can't be without a domicile, and you can only have one domicile at a particular point in time. It is relevant in Ireland for determining your scope to Irish income tax, Irish CGT, and Irish capital acquisitions tax. And there's 3 kinds of domicile, the same as in the UK. You have a domicile of origin, so everyone's born with a domicile of origin. That stays with them until they obtain a domicile of choice, which can be obtained if you are resident in a new country and you intend to reside there permanently or for an unlimited time. And then the third basis is a domicile of dependents. That's for minors up until they're 18. So we have no deemed domiciled rules, and traditionally it's quite difficult to obtain a domicile of choice. However, that changed ever so slightly not too long ago in a UK case, where previously it was believed that if you could show you had sufficient ties with your original domicile, you had a burial plot there, you had property there, you had personal economic ties there, that would be sufficient to keep your original domicile alive. In a case back in 2011, Perdoni versus Garati, an individual who was asserting he had an Italian domicile because he had a burial plot there, he had property there, he visited the country regularly. Notwithstanding all of that, the UK courts held that he had a UK domicile because he didn't have an intention to return to Italy upon a clearly foreseen and reasonable anticipated contingency. So what does that mean? It means that he just must have shown that there was a point in time where he would definitely have gone back to Italy, and there was some contingency that would have spurred a move back to Italy. And absent that, they upheld a UK domicile. So learnings here is that it's important every couple of years where your domicile becomes questionable or where it's ambiguous because you're spending more time in the country, that you document the circumstances surrounding your intentions to stay in the country or to otherwise not stay in the country and move back and relocate back to your domicile of origin. Next slide there, please. Yeah, so it can be a complex area for the reasons just highlighted there, especially when you consider in these days highly mobile people and the cross-border nature of business activities and people living in multiple jurisdictions. It's, as well as that, it's a subjective test. It's an intentions-based test. So oftentimes that can be very hard to assert or stand over. So always very important that there is support and documentation and backup there to support the surrounding facts and circumstances underpinning that intention, and that intention that there is a contingency upon which you would not stay in Ireland for an unlimited period of time, and that you would relocate back to the UK or relocate back to the country of your original domicile. And lastly, the burden of proof rests with the person asserting that a domicile has changed, except in a circumstance where an individual is claiming a relieving provision, like in Ireland under remittance-based tax. If you're claiming that relieving provision, well, then the burden of proof flips back onto the taxpayer. So it's an important consideration to bear in mind. Next slide, please. Okay, so that's domicile and residence. So what does that mean in terms of your scope to Irish tax? So for Irish income tax and CGT, this table here gives you a very good summary of the impact of your Irish domicile or resident status. So if you're resident and domiciled, well, then you're liable to Irish income tax and CGT on your worldwide income gains. Very simple. If you are resident but not domiciled, well, then you're only subject to tax in Ireland on Irish source income, Irish gains, and foreign income to the extent that it's remitted to Ireland, and foreign gains to the extent that they're remitted to Ireland. And then if you're not resident and you're not domiciled, well, then you're only subject to tax on Irish source income and the disposal of Irish specified assets, which is Irish land and buildings, mineral rights, the usual tangible assets in state. So next slide, please. The scope to Irish tax for capital acquisitions tax then is slightly different. So again, capital acquisitions tax applies to inheritances and all gifts. We do have tax-free thresholds, but they are modest. There's three groups, Group A, B, and C. A refers to transfers between parents and children, and the tax-free threshold is 400,000. Group B is then 40,000, and Group C is 20,000. So the scope to tax is pretty wide, and it applies if the, to keep it simple, the giver or the receiver of the gift or benefit is resident or ordinarily resident in Ireland, or the asset is an Irish Situate asset. But special rules do apply for non-doms. So non-doms are only considered resident for capital acquisitions tax purposes if they have been resident in Ireland for 5 consecutive years preceding the date of the gift or inheritance. So if you came to Ireland and triggered residency in 2025, it would be 2031 by the time that an Irish CAT charge would apply on the transfer of non-Irish Situate assets. Remember, Irish Situate assets are always within the scope of Irish CAT, so it's only foreign assets that can be gifted or inherited as in between non-doms in that 5-year period without triggering an Irish CAT charge. Next slide, please. On summary, income, if you're non-dom, remittance-based tax and foreign income. For CGT, you also have the remittance-based tax and foreign gains. And for CAT, you must have 5 consecutive years residency before you come within the charge. Other notable factors are that there's no remittance-based tax charge in Ireland. There's no requirement to formally elect for the remittance basis. So if you're a non-dom, it automatically applies. And there is no cap or time limit on the remittance-based tax. Next slide. Okay, so as with most tax matters, complexity is never too far away, and the remittance-based tax isn't unique in this regard, and the devil is always in the details. The first, I'll run through some of these, but the first is really around identifying from what sources of income the remittance is being made. There are 3 general buckets that this can fall into. The first is clean capital. So clean capital refers to income or gains that have been accumulated prior to becoming Irish tax resident. And remember, if you're Irish tax resident, you're resident from the start of the year, you're resident from 1 January. So even though you might relocate to Ireland in April and you're tax resident in 2025 because you spent more than 183 days from April to the end of the year, any income from the 1st of January will be taxable in Ireland, notwithstanding that you weren't resident at that point in time. So your clean capital refers to income and gains that would have been accumulated up to 1 Jan, so 31 December in the year before you become resident. The second bucket is income. So any remittances out of foreign income are subject to Irish income tax at the marginal rate of 55%. And then the third bucket are remittances of foreign gains. And these are subject to foreign capital gains. And these are subject to CGT at 33%. So that seems straightforward. But when you have a mixed fund or mixed accounts, precedent there is that any remittances from such account will be deemed to be first made out of the income that sits in that account that was post becoming resident, so taxable income. And then when that is exhausted, it'll come out of the capital gains post becoming resident. And then it's only after that's been exhausted that those remittances will be deemed to come out of clean capital. So it is essential that pre-planning is undertaken and separate accounts are established before 31 December when relocating to Ireland, so that you have a clean capital account from which you can bring money into the country and not suffer any income tax or CGT on, and that any income that's being earned off that account is being mandated into a separate account from which any remittances therefrom will be subject to income tax or CGT depending on the nature of the income. Next slide, please. So some other considerations there, possible pitfalls. A lot of the complexity derives around what exactly constitutes a remittance, and definition from our tax is there. But the obvious examples include, withdrawing money from a foreign bank account or lodging foreign earnings into an Irish bank account. But the definition is much wider than this and includes actual sums received in Ireland from a number of different sources. So from money received on credit, Irish expenditure using a foreign credit card settled by a foreign bank account will be considered a remittance in Ireland. Actual sums received from property imported. So the importation of an asset, if disposed of in Ireland, is going to be a remittance of the foreign income used to acquire that asset. So if you import a car, for instance, which was acquired out of foreign income, importing that car and selling it in Ireland will be considered a remittance of that foreign income. There is an important distinction between income and gains here, in that the actual mere importation of the property, if it has been acquired out of a foreign gain, will be considered a remittance of that gain when you bring it into the country. So if you have a foreign gain, you decide to buy a nice painting with it, you bring that painting into Ireland, the importation of that painting into Ireland is considered a remittance of that capital gain that was used to originally purchase that foreign painting or that painting. And then after that, we have some specific anti-avoidance rules around loans. And in summary, they are designed to prevent Irish or foreign loans being obtained and settled out of foreign income. So the use of those loans in Ireland, but they're being settled and paid out of foreign income, which wouldn't, without these anti-avoidance provisions, wouldn't be considered a remittance. So if you take an example of an individual relocating to Ireland, one big expense or outlay upfront might be the purchase of a home. And if they got a loan to purchase the property and were paying the capital and interest of that loan out of foreign income, that would be deemed a remittance of that foreign income under these rules. Another consideration is there is no loss relief for capital losses remitted. So losses can be offset against gains, but if it is a foreign if you are a non-dom and you have a foreign loss and you remit that loss, that can't be used against foreign gains in Ireland. And if you're remitting gains, you are first considered, Irish tax authorities' views are that it's first considered to remit the gain before you remit the capital. So if you made a disposal and you got proceeds of 2 million, and out of that 2 million, 500,000 of that was a gain, and you remit that 500,000, you remit 500,000 of the 2 million first, but that'll be deemed to come out of the gain part first, and all of that 500,000 will be subject to Irish CGT before you get into the remaining 1.5 million original cost. And they don't tax the remittance of that 500,000 proportionally amongst the base cost and the gain. So next slide, please. Other considerations, changing circumstances. So if you've been in the first couple of years, it's very unlikely that you're going to acquire an Irish domicile of choice. But as the years roll on and the longer that you're here, that possibility increases. And there's a potential opportunity where you do acquire a domicile of choice. You can remit all the accumulated foreign income before that point into Ireland, and doesn't trigger a remittance, because from that point on you're only taxable on your worldwide income and gains, and not on a remittance basis. Another consideration there is again pre-planning to remit foreign income for which credit is available. So if you've suffered foreign tax, and you also have other income that hasn't suffered foreign tax, and you need to remit either the income that's suffered foreign tax or the income that hasn't suffered foreign tax, you want to remit the income for which you can get a credit in Ireland. So segregating funds so that you have high foreign tax income and low foreign tax income, and that you can maximise the availability of foreign tax credits and manage your overall effective rate of tax. Offshore fund gains do not qualify for the remittance basis. This is because they are taxed under Case 4 and not Case 3 in Ireland. So most EU investment funds that are governed under the UCITS regulations are treated as offshore funds. And my understanding is that the composition of a lot of the individual savings accounts in the UK is made up of offshore funds. So any gains arising on such accounts wouldn't avail of the remittance basis of tax, again, because they're taxable under Case 4 in Ireland, not Case 3. Next slide. Double tax treaties. Again, to consider, one, do you get a credit on the remittance of the income which has already suffered foreign tax? And then secondly, specific to Ireland and UK, there is a limitation of relief built into our treaty, which basically says if you have a person that is availing of treaty benefits and also the remittance basis of tax, but then the treaty benefit will be removed to the extent that the remittance basis has been applied on the relevant income. So if you're dual resident and say the treaty affords sole taxing rights to Ireland, you can't get that benefit as well as the remittance basis of tax, such that you would have no tax on that source of income if you were availing that relief under the treaty. Next slide. Recent developments. So until 2008, the remittance basis of tax in Ireland didn't apply to UK source income, and those rules were changed because it was anti-EU. Could this reverse? I haven't heard any murmurs or signals that it would, but something to keep under consideration. Commission of Taxation report in 2009 recommended that we get rid of our remittance basis of tax, but we haven't. Again, the 2022 report on the Commission of Taxation of Welfare recommended a 3-year limit for remittance basis, but that wasn't introduced. And recent soundings are that there's no political appetite to change these rules. And new government was recently appointed, centrist government. They'll be here for the next 4 years, and can't see any changes being made by this current government, but it is an area to be kept under review and I guess to watch this space. Next slide. So in summary then, just some practical considerations that we advise all clients when relocating to Ireland. I've touched on most of these during the course of the presentation, but I'll skip down through them real quick as a kind of summary. Identify your capital accumulated prior to becoming an Irish tax resident and place this into a separate account. We can remit that income tax-free. Set up separate bank accounts containing capital so that any income paid on this capital is credited to a separate account, and you don't have a mixed account there whereby any income that is, or any funds that are remitted out of the account are deemed to first come from the income. You keep the accounts clean. Review your investment portfolios for investments that don't qualify for the remittance-based tax. So, for example, UCITS funds where any gains on those funds are taxed under Case 4, and there's no remittance basis tax on them. Consider whether it's appropriate to rebase investments for CGT purposes prior to coming to Ireland. Again, obviously being mindful of any foreign taxes that might be triggered as a result. Assess your future needs for spending in Ireland. So again, it mightn't necessarily be the best approach to remit all your clean capital and use all that up in your first few years. If a better approach would be over a 10-year period, let's say, to use some clean capital and some foreign income up to the higher rate of band in Ireland to smooth out your effective rate, rather than using all clean capital in the first few years and then going into your foreign income and triggering a remittance that could be taxed at the higher rate of tax in Ireland. And then consider your family tax planning prior to becoming an Irish tax resident. So really here, it's to what extent can you gift funds within the first, or assets within the first 5 years, foreign assets, and avoid triggering Irish CAT and a gift of those funds. So I think that concludes my part of the session, and we're not massively over time, but I guess we do.
That's fine. That's right. We're thinking these are 3 questions, one for yourself, Cian. So let's start with that one. UK company with a sole director resident in Ireland, is director's income paid through an Irish PAYE or UK PAYE scheme? I'd add to that, with the fact it's a sole director, I mean, it's actually the company might have residence issues for Ireland as well. So
yeah, that's so directorship is always an office for Irish tax purposes, and any payment on foot of the director remuneration is always subject to Irish PAYE.
Excellent. Right, the other 2 are to do with Rebecca's session. I can answer them actually, Rebecca. The first one is on the purchase of own shares. Purchase of own shares to fund IHT available if the deceased is connected with the remaining share. Is it available if the deceased is connected with the remaining shareholders? I think the issue here is that when you look at section 1033 of CTA 10, there's actually 2 conditions, and you meet one or the other to get the relief. The first one, condition A, is the normal one that we see where you have to have 5 years ownership, reduction of more than 25% of your interest, and not being connected, you and your associates not being connected, which is a 30% test. So that's all condition A. Condition B is the one that Rebecca described, which is all about talking about the hardship, and if it's specifically used by, and if you meet condition B, then everything else in condition A is irrelevant. So you don't have to worry about the fact that if you're still connected. You could just sell 10% of your shares. You don't have to sell 25%. It's whatever you need to pay the IST. So I think I've answered that one. The other one was a life insurance question, which is correct. If the estate is the beneficiary of the policy, does that mean that the proceeds are then within the scope of IST? The answer is yes, which means you would need to gross up the receipt, the amount insured, to make sure that after the IST it is actually covered. I should say that if it's a sum assured life insurance, in other words, and there's insurance for this, but it's not an underlying investment thing, then it shouldn't be any income tax, or in all these life insurance policy gains would not apply. It's simply not taxed. So yes, you would need to gross up for the IST that comes in because it's deemed to be received the day of death or immediately before death. So that's it. I think that's all the questions. Next slide, please. There's everybody's contact details. Next slide. Well, okay, that's fine. Just for me to say that the next webinar is on the 16th of April. During that, I will be talking about intra-group transfers of assets and trade, so the various group reliefs and how they're treated. And one of our employment tax people will be talking about umbrella companies. So anyway, thank you all for joining us. Thank you for the speakers, and see you next time. Thanks.